Hello, Professor. Hello, everyone. I'm Lim. I'm here to help with accounting records. First, we discussing about double entry accounting. Double entry accounting is a similar yet powerful concept. Each and every one of the company transition will result in a amount records into at least two of the accounts in accounting system. In the double entry system, transition a record in 10 of debit and credit center. Debit is one account observed an account credit in another. The sum of all debit might equal the sum of all credit. The double entry system of bookkeeping standardizes the accounting process and improved the accuracy of prepared financial statement, allowing for improved detection of error. Except for some very small company, the standard method for recording transactions is double entry. Double entry bookkeeping or double entry accounting means that every transaction will involve at least two accounts. As you can see that here's an example transaction, the two accounts that will be impacted. Debit and credits, which is similar to explain as accounting concept as a actual physical things. In your company, each transaction result in a debit to one account and a credit to the other. Together, they represent the money coming into or going out of your company as one account grow and the other mass contract. For instance, a transaction that increase your access would be noted as a debit to the specific access account. Transaction would also be noted as a credit in another account on the other hand. Debit increase access and expand account, whereas the credit increase venue, liability, and quality accounts. Every debit and its corresponding credit should always add to zero. Let's jump into T accounts. T account is a visual representative of accounts in the form of alphabet T. Debit transaction always recorded on the left side of T, and the credit transaction are always recorded on the right side. The vertical line of the T divided the credit and debit. As a result, it is simple. It is similar to visual follow debit and credit or additional and subtraction to each account. Since every transaction would involve at least two accounts, we recommend that you always begin by drawing two accounts. For example, a company pay its rent of 2,000 for the current month. That transaction could be paid with the following T account. Note that one T account has debit of 1,000 and that one T account has a credit amount of 2,000. The transaction has debit equals credit. Trying accounts and a balance sheet are two very important financial document for any business, however many different distinguished report for each other. A trial balance is usually prepared as a financial tool preparing a balance sheet of the company. A trial balance summarizes the closing balance of the different general ledger of the company, while the balance sheet summarizes the total liability, assets, and shareholder equity in the company. A trial balance is used in bookkeeping to list all balance in your business general ledger accounts. These are two columns in it, one for the credit balance and one for the debt balance. The total in each column need to be equal in order to maintain the balance. The trial balance provides quite an easy way to verify that every transaction had a corresponding credit and debit. They give you a financial framework for both your profit and loss account and balance sheet to ensure that you book or balance and you can prepare your trial balance on regular basis. For instance, trial balance accounting is frequently used by organization at the conclusion of each reporting period. These are the key difference between trial balance and balance sheet. Trial balance is an internal statement for use within the company and balance sheets for external statement. The trial balance is divided when debit and credit, and balance sheet is divided into assets, liability, and shareholder equity. The balance sheet always maintain the equation. The trial balance lists the closing balance from the general ledger, and the balance sheet use the trial balance as a source. Trial balance is record to ensure the accuracy of financial record, and a balance sheet give overall picture of the financial effect of the company to the stakeholders. A trial balance need not to be signed by the auditor, while balance sheet must bear the signature of the auditor. Trial balance is recorded every month, quarter, half year, and annually, whereas the balance is prepared at the end of every financial year. Balance sheet is the final statement that report a company X liabilities. Shareholder equity balance sheet prepared as of a specific point within point in time. It will provide as a quick snapshot of our business finance, typically at a quarter or a year, and provide insight into how much debt or how much debt our company has. Let's look at the axis first, and cash equivalent, short-term investment, inventory, current income tax, assets, foreign currency, etc. These can be considered as current assets. Current assets that easily be liquidated into cash. On the other hand, long-term assets or non-current assets are things you don't plan to convert to cash within a year, which are building in land, long-term investment, and benefit, etc. And the liability section, we talk about current liability, which can be paid off within a year. We will consider the following things and current liability, like short-term financial debt, current income tax liability, short-term, and so on. Then current liability include long-term financial debt, employee benefit liability, deferred tax liability. Equity is money currently held by your company. This category is usually called owner equity for sole proprietorships and shareholder equity for corporations. Should belong to business owner and portfolio of the investment. So you can compare our latest balance sheet to previous one to examine how our finances change over time. Thank you.